go as well. There's so much going on. Andrew's going to talk about the data, and he's going to introduce himself here first in a second. My name's Nicole Rueth. I am a branch manager for Fairway Mortgage. I'm also a sponsor of DMAR's Market Trends Committee. I'm kind of a data geek, so I'm really going to talk. My second half of the presentation is going to be more about what's going on in the economy, what's going on with the GDP, the talk of recession, what's going on in the lending world, so that you guys from the realtor space can kind of understand the backstory. And I'll kind of share everything I know, obviously open up to questions throughout the entire presentation, both Andrew and myself, because a lot of times it's best and easiest to ask the question right when we're there. So please feel free to jump into the group chat and ask any questions. Andrew will watch it while I'm talking. I'll watch it while he's talking. He starts out for about an hour and then I kick off. But Andrew, do you want to introduce yourself?
Sure. My name is Andrew Abrams. I'm a broker owner of A Squared Real Estate, and I'm the vice chair of the Market Trends Report. If I start looking at the camera kind of different ways, it's because I have two screens, and so I can see myself on one side and then look on the other. But yeah, the Market Trends Committee and the report itself is used as a tool to help you and help you in any way you want. So realtors naturally, right, like use that information very differently. And we'll kind of go through that. But, from what I've seen, everyone kind of does their own business differently. And what this is meant to do is to really individualize like how you can best utilize it. So we'll be throwing a lot of information at you. If it's a little overwhelming, don't worry. That's normal. And you don't have to use it all. Use what's natural to you to help grow your business and make sure that it kind of helps you to understand what you need. A lot of the information we're going to talk about is from last month's data. And so while I'm sure we want up to date every minute exactly what's going on, what we're really trying to do here is teach you how to fish, so that way you can keep track following the market trends report to see the ebbs and flows and make your own assessments.
Absolutely. All right, so I'm going to share my screen really quickly and we'll start off. One thing I noticed, sometimes people will say that the screen share is really small, and it has to do with the view. Everybody's got the ability to change their view in the top right of Zoom. So I'm going to go ahead and share this, and then I'm going to ask first if you guys can all see it, and then we'll start taking off on the presentation. Let me shut that down. All right. So can you guys see the warning graphic images PowerPoint slide, and can you see it large enough? All right, I'm seeing plenty of nods.
It looks great, Nicole.
Okay, good. All right, so here we go. So why we put this course together is because we really felt, so there are, Andrew, what are there, 18 of us now in a room, and we have a list of all their names here in a couple minutes, but we were all coming together and we were talking about what are we seeing in the marketplace? How are our buyers reacting? How are our sellers reacting? How are we communicating with them in a way that they can make the best decisions for themselves, for their families, for their financial success? And we realized we had all these great conversations and we were using the report to its fullest extent, but some other folks had told us that it was complex or that it was large, and it is large and it is dense. So that's why we decided to kind of put this together, as well as to help you guys to become the advisor. You're already reaching there. So how can we assist in the continued growth of that aspect of your business, right? Because what we don't want to do is be transactional. I always tell, I coach a lot of loan officers. I have been coached for 5 years and I do a lot of coaching, and I'm always telling the folks that I'm coaching, don't focus on the transaction, focus on providing value, focus on being the advisor, be the go-to, and the transactions will take care of themselves. Much like you think of a lawyer or a CPA or a financial planner, you don't think of them as transactionally setting up your account, or else you'd go to Charles Schwab, right? Or else you'd go to TurboTax. You think of them, and I pay them more because I want that advisor role. I want them to be able to give me their advice, and I want them to understand the market, their market. Tax code, for example. I don't trust TurboTax. I want to trust the realtor to be deep into real estate and to know contract law and know the things that I need to know to protect me when I go in. So that's, anyway, bottom line is how we go about doing what we do is all to be that advisor role, because there's so many disruptors right now. There's so many loud noises and everything that's going on. Now, we've all seen what's happening right now with the iBuyers. The iBuyers are taking a back seat. It was, I often joked, it was a race to the bottom. Who could spend the most amount of money and go deepest in the hole without failing? And ultimately, regretfully, they got caught by what's happening with COVID. And so a lot of the iBuyers have pulled back, waiting to see where the market goes. But in the meantime, you have other disruptors that have been there and will continue to be there. Things like the big data analysis. Zillow might not be buying homes right now, but they're still collecting data. They're still analyzing data. Amazon is doing a phenomenal job of collecting data. They just hired 100,000 employees, just like Walmart did. They're continuing to grow that data share in the background. They might not be front and center right this second, but they're absolutely capitalizing on technology and growth. You know, using kind of artificial intelligence, machine learning, virtual and augmented reality. I just taught a class about an hour ago on doing virtual open houses and virtual listings and buyer representation. And the use of technology in this space is growing abundant, and it's growing fast. And so making sure that we're aware of all of those disruptors is critical, but understanding and being those boots on the ground, understanding the data allows you to communicate in a way that sometimes if a client is looking at two perspectives, they're going to want the perspective that knows the market, the perspective that understands why are home prices or the transition of neighborhoods or the buyer movement, the businesses coming in, everything that's changing real estate in and around us is what we need to kind of keep focusing on with everything else going around. The Internet of Things is such a unique concept, and so I just love it. It's everything. It's our cell phones. It's everywhere. It's following us. And we have access to everything all the time. And so how do we give them that virtual experience? How do we create video tours and pictures that display truly the home? And how do we create that experience for our buyers and sellers inside the Internet of Everything? 5G is taking off, and then drones. I often joke, when they can figure out how to get a drone in a front door, it's changed everything. So right now we're dealing with COVID, and we're trying to figure out where we sit in all of this. And growing and going deep in the data analysis is so key, because right now there's a lot of realtors and lenders both who are sitting on the sidelines kind of waiting to be able to go back to work. So how are we taking this time in continuing to go deep on those skills and that acumen and creating that lane? And for me and Andrew, one of our big parts of our lanes is understanding the data, being able to relate the data in a way that our clients know that we're their best advisor, that we're going to help them to assess when the right time to buy, when the right time to sell, maybe what neighborhoods to avoid or what neighborhoods to jump into. So understanding what our lane is in the midst of everything else going on and being that resource, having clients continue to call us throughout this period of time. They might not be able to or choose not to list a home or buy right now, but they're ramping up and they're getting prepared to do that as soon as they can get out. So why study the market? Why study the DMAR Market Trends report and all the data that's in it? Is to create adaptability and innovation inside all the changes and the disruptions that I just talked about. There's so much information being thrown at us so fast and so constant that we need to know, okay, who are we in this space? And being able to adapt and innovate means that you have to kind of know where you're starting from, the data and the environment, the culture that we're creating our expertise. It also creates creative thinking, gives a benefit to our buyers and sellers, helping them to negotiate the fear, because fear creates inability to move and take action. So we've got to get them, and maybe it's not getting into the market, maybe it's sitting on the sidelines, but being able to get into the market in a way that's best for their family. And then being able to provide that educated information. A lot of times, so I'll do videos right after the Market Trends report comes out. I know Andrew does some social media around the Market Trends data. He putting together a report, sending out emails, blasting out or putting it on Instagram or whatever it is, the tools that you use, creating that ability to be the market leader and capitalizing on that data that we give you, because we're the first to market with that data. So how can you use that data, which Andrew's going to go through, to express your experience and your expertise in this market? And then finding, I love this last one. So finding the financial opportunities for yourself. Like, I own 24 investments myself. I know Andrew is an investor, and it's always that ability to know what neighborhoods are hot right now. Where's the market shifting? Where's Denver putting their money, or the other suburbs putting their money? What's happening right now with the real estate, so that we can take advantage of that, not only for our clients, but personally, because being able to take advantage of those opportunities makes this job long-term, right? It sets us up for long-term success, not just temporary transactional success. So Andrew, I'm going to turn this over to you. I'm going to stop sharing and let you share and take over for the next 45 minutes or so.
All righty. Can you guys see the why I study the market here?
I can.
All right. Perfect. So as Nicole said, and you know, I obviously, with this being on Zoom, it's a little different because normally I'm used to interrupting Nicole just about every other sentence that she gives, because, and you'll see this kind of on the second part of our presentation, the information she gives is absolutely fantastic and robust. And as a realtor who's like very into, I do some fix and flips. I work with some investors. I like rental properties. I help traditional buyers and sellers. You know, you kind of want to be able to strategize and at worst have a really good elevator speech. So while we go through this, I will certainly be giving you some of kind of my favorite slides that we'll be talking about. But likewise, especially on that second half with Nicole's information, that's a little bit outside of what I would consider my normal day-to-day, which is why we have resources like Nicole. You know, definitely on that group chat, ask questions. If you can't tell, our impulse spelling right back isn't going to be perfect, but we will try to get all of your questions answered. And again, the goal of this is for you to utilize it for your business in any way that you want, and to kind of understand why we get the numbers we do. So again, where we get that data is from RE Colorado. We pull the data on the first of the month, and we really want consistency. So every single month, we pull the data on the exact same day, and same day, not like Mondays, but I believe it's the first day of the month. And then, you know, we get all the reports and all the numbers on the third day. We write our reports and we get everything out by the fifth day. And the point of that is that consistency over time. So what we're reporting on is the 11 counties, as you can see below. Those are the 11 counties that we are reporting on and that the data that we're getting from. And so, you know, sometimes people will have a little different numbers and you'll say, well, why do you have a little different numbers? And the answer will be, you know, there might be using different areas or pulling the data at different time. So the Market Trends Committee is basically made up of a group of realtors and Nicole, so members and sponsors who we really like the Market Trends Report. And the reason why I say we like the Market Trends Report and not we're all like big numbers people like is so we, you know, everyone kind of uses the numbers very differently. And I think that should be noted is not everyone on our report, on our Market Trends Committee loves the number side of it, but they still want to find a way to use it, even though it's not their strong point. So again, the Rueth team here is our sponsor, and these are all the members of our Market Trends Committee. So there's a lot of really intelligent people who give a lot of really unique perspectives on that. So, you know, as with all statistics, you can make jokes about them. And so with our Market Trends Report, we have 29 total pages. We have 11 county coverage. We have 19 pages of charts and graphs and 4 pages of market insights that specify within kind of specific price parameters. So the classic market is between $300,000 and $500,000. The Premier is $500,000 to $750,000. The Signature is $750,000 to $1 million, and the Luxury is over $1 million. So if you are going into, let's say, a listing presentation, you can even take a screenshot out of our Market Trends Report and say, hey, you know what? This is kind of a broad scope of what's going on in your market. And then we'll show you a little later on. You can even go within like $100,000 price points on where inventory is at. So two of the numbers that we use that throughout the report is the average and the median. And I think it's just important for people to remember the difference between those. So the average is the mean of kind of what everything adds up to. So you can see at the top here, there's that 160 number, and that makes the average 31. Whereas with the median, and you have a similar amount of numbers, with 160 in there, it doesn't calculate it the same because it's the middle number. So any outliers are kind of eliminated more with the median. So while you can get a faster calculation, all the data entries are equal. So overall, so this is one of my favorite pages to view. This is like, I think about the third page or something like that of the market trends report. And this is going to kind of show you what's going on in the market today, and then also compare it to last month and last year. And so I just want to remind everyone that all of the numbers that I'm providing for you right now is March's numbers. So we can see the numbers from March, but we have to remember that the quarantine and everything like that really didn't happen until almost middle of the month to late in the month. So the numbers from the quarantine, from the showings being decreased, and from what's really happening in our market today is not necessarily reflective of the numbers that we're showing here. And I think that's just important to note, but likewise, if you can get used to kind of following this every month, you'll be able to start tracking and seeing what the difference is. What the numbers have kind of shown so far is that we were really off to one of the hottest starts, potentially ever. Like prices were going up a lot, inventory continued to somewhat dwindle. And a big reason for that was a shortage of inventory in December. So in December, we had about 10% less houses on the market and 10% more sales. And so with that kind of 20% decrease, I'm sure as most of you know, like January was off and running really fast. February was off and running. March was running really fast. And then boom, we all hit a pandemic wall that has completely set us back. So again, it's broken out by overall the single family detached market, then just the detached and the attached. And so when you, I kind of went backwards there. So as you can see, for the active inventory, we ended the month with 5,700 houses on the market, which is up 20% from the previous month, but overall down 8% from the year before. And I think, if you want to see kind of the ebbs and flows of some seasonality, that's where some month-to-month data is important. But overall, comparing, in my mind, March to March of last year really shows where we're at more. Likewise, same with the amount of closed homes and average price, days on market, things like that. So on the market insights page is a whole bunch of interesting kind of information, and it really has a wide range of information, some of which is from our Market Trends Committee, just giving their opinion on what they're seeing out there. Again, we have a very diverse group, so we have a lot of different opinions that might give you an insight on, some ebbs or some trends of land versus investment properties versus what builders are doing, or just what traditional buyers and sellers are doing. Also, and it has shifted a little bit. For my favorite part, and where I think you can really get your elevator speech down, is in the quick stats tab. Because if someone wants to ask, and again, I would say this during normal times, if someone wants to ask what's going on in the market, I normally tell them how many houses are on the market, so about 5,700, and then I compare it to average for March, which was 14,250, which is drastically lower than the high in 2006 of 27,000. So, to give kind of perspective of everything, okay, what inventory was up to 5,700 houses, should we be concerned? Well, relative to the average for March of 14,000, I mean, we are drastically below that, and compared to the peak, we're at about 25% of the amount of inventory that we had in 2006. So, that is like definitely, if I give kind of two snippets or like my elevator speech, that kind of helps show people where our inventory is at, because we'll get to the page, but prices are very much dictated by supply and demand. How supply and demand is created is kind of a different story. So I go backward. I did go backwards. So again, we can't just come up with blades. So another kind of fun joke. So our chair is Jill Schaefer, and Jill is almost self-proclaimed to not be like a huge numbers person, but she kills it in real estate, and she gives a great overview of what's going on in the real estate industry and the real estate market. So this is one of the first pages of the Market Trends report. And what it does is give an overall perspective on what the market as a whole looks like. And then you'll see stats that kind of follow that. And then after that, you'll be able to see like more specific price points. Another graph that I love to show people, and this is by far, I think, my personal favorite, is this one. And it goes from January of 2008 until March of 2020. And as you can see, we have active listings here. And you can almost see the peaks there in 2008 of 25,000 plus. And then you have the sold listings. So, you know, a few things that I take away from this graph is one is that generally demand, which is that sold listings piece, does not change that much. You can see kind of the ebbs and flows year in and year out are relatively pretty consistent. And kind of the uptick, in my perspective, from early 2008 as things kind of trickle through to 2014, where those numbers rise a little bit, our population also grew. So I think that is somewhat of a correlation. You can also see on those sold listings how there's that ebb and flow through the year. That kind of shows the seasonality of the market. And we all know that I always say everyone's on a school calendar year, whether you have kids or not, but I always just said that blindly because it just sounded like it made sense to me. But this really shows that. Likewise, for the active inventory or the active listings, this is really showing, hey, what's actually out there. So right now, and we'll get to, you know, showings that are down essentially 50%. I personally don't know if showings are down 50% because there aren't houses on the market or there's not a buyer demand. And so that's something that like we won't really be able to understand on how we're going to be impacted after this, but it very much shows kind of that relationship. And when you get into some of the like January 2017 and when we talk about months of inventory, which is essentially if no other houses were put on the market and there were 2 months of inventory. So after 2 months, there'd be no more houses to sell. So at a certain point here, that overlap showed a really small months of inventory, like so small that after a month, there might not be any more. And as that gap widens, that's where the transition goes from a buyer's market to a seller's market, which we're not in yet. So overall, you can also show the month-to-month and overall for active listings at the month end. So again, this is just showing that 11 county report with the single family detached and attached properties with quite a bit of information. My favorite number on this one, without a doubt, is sales volume. Because if you look at sales volume and you can talk about $2.2 billion in sales, it's just a really fun number to use. And also can kind of show you average price versus median price and how things have changed from both the previous year, which can show appreciation, and then also just the previous month to see how the momentum is going within the industry. So that's what kind of focuses on this. I think the other interesting part, I personally just like looking at the close price versus list price to see how close are we getting to what we're actually asking for. And I know during like 2017, the average was about 101%. So whatever anyone was listing, on average, they were getting a little bit more than what was listed for. And then we also have year-to-date data. And that year-to-date data goes back over the last 5 years. So you can not only just look from the previous year, but also from the previous 5 years and see how those things have kind of changed throughout that time. And again, I think people really like some historical data. And so this kind of shows what the last 5 years looks like. If you even look like an example of like sales volume, so sales volume, was at $4 billion. Now it's at like 5.6 at the end of March. And so when you look at actually like the amount of closed properties, it went from 10,671 to 11,470. So over the last 5 years, the amount of sales, each of those years, actually very consistent, which, again, goes to my point that I think that demand is similar, but because prices have increased, so has the sales volume, which is why our average and median numbers are higher, And likewise, the $5.6 billion number, which is a fun number, is up. And then likewise, if you're a little more focused on detached or attached, you can then look down below and you have detached and attached data to follow as well. NAR describes a balanced market as 4 to 6 months of inventory. So right now we're at 1.27 months of inventory, which very much shows a seller's market. And I think, you know, for me, I think this is just my own personal tangent, but I think the real estate industry as a whole does not talk about buyer and seller's market the right way. And in that sense, it's, you know, what it kind of means is, okay, who kind of has the competitive advantage, but it really doesn't reflect the psychology and what it means to the actual buyer or seller through that process. So we saw in 2008, basically 2012 to 2018, it being a seller's market so much that buyers just said, okay, what do I need to give you? I'll do anything you want, appraisal gaps, as is, you know, I will marry off my first child, whatever we need to do to get this house, that'll be okay. And then in 2019, things slowed down a little bit. So even though it was still a seller's market and months of inventory still reflected a seller's market in 2019, it had shifted where days on market had increased a little bit. So what did that actually reflect for the buyer? Well, they were actually allowed to look at a house more than the first day it was on the market and have a little time to think about it. They could actually negotiate some form of their inspection objection. And I think that's so even though technically, you know, the newspapers and media can talk about, oh, it being a seller's market, I really think as it's more of the change of what the months of inventory was at to what it is now, and the psychology shift behind like consumers as a whole, and what that means for you on the ground. And does that have more time? Do you have more opportunity to put in lower offers? And I think that would be the thing that I would stress the most with all of these numbers is how does it actually reflect your buyers and sellers? So this is that market trends report showing the amount of closed and active properties by essentially $100,000 price points up to $1 million. And then after that, they just throw that $1 million in together. Again, months of inventory just reflects if no one else put a house on the market, how many months could we go until we had no more houses to sell? And so if you have a listing and it's at a certain price point and you want to talk about months of inventory, that's who you could kind of zoom in on this graph and talk to your buyer or seller on what that means. And again, the lower the month of inventory, kind of the higher demand, which is why there's not a lot of listings in 0 to 100,000. So I always take that with a grain of salt, but everything else you can essentially see between 100,000 and 500,000. There is very low inventory, or there was throughout March. And then, you know, as you go up in price point, so even 500 to 750 was not a lot. And then as you start to trickle up in those price points, that months of inventory started to increase, which I think logically just makes sense as well. These are our expert opinions. And this is where, again, if you're in that specific price point segment, we have different people writing every single month to kind of talk about what they're seeing in those specific price point segments and kind of observations using the numbers. So I always encourage you to use the numbers and make an analysis for yourself. But if you want some direction, what we write in there for the price segments, I think create a lot of value. So again, when we're writing those price segments, the information that we get is right here. We're using the same information that you have and just kind of doing our analysis. So this is talking about over $1 million. What are we seeing? So in March, basically throughout the year, we saw 202 sales, which is up quite a bit from the previous month and last year. Things were really heating up. And as prices got more expensive, naturally as well, like especially the $1 million price point, people were buying more. Yeah, there's also some condo tangents I can go on. But so along with some month over month data, we also have year to date data. And again, likewise for that $1 million price point, we can see that just the amount of people that have come here, the fact that condos can start to be developed again, and they're generally at higher price points, and there was so much development going on. We saw so many more properties being bought over $1 million, and that's all reflected in the numbers. And I think the thing that's important to always kind of challenge yourself is we all feel a certain way based off of how things are going, but you always want to check in on the numbers to see if you're actually validated and, hey, and what my feelings are, is everyone else feeling that? Do the numbers actually reflect what we're seeing? And so I think before I jump into like the 12 county report, I did just kind of want to jump back into what we're seeing today. Actually, I'll save that at the end on kind of my take on how to use this report to help understand what's going on while we are quarantined, and then as well for afterwards. So when you go to the DMAR Realtors website, there's different county reports too. So if you're in a specific area, obviously every house that you evaluate is very specific within its own area. And I wouldn't even just say like, oh, this house is in Denver, therefore let me look at all of Denver stats, right? Like, of course, with the CMA things that you're doing, you're really going to hone in on your specific information. But if you want a perspective on kind of how the city or the county is moving and some really good, unique information, especially as a marketing tool for listings, there are these. So it's kind of a balance, right? Keep it simple. I don't think they let me put in the keep it simple stupid, but still works. The market overview. So we also have this, which is an infographic of the market overview. And this is where I see the most amount of other realtors using this to market themselves. And that's great. Nicole and I and everyone on the Market Trends Committee is here purely as a volunteer. We're just realtors. And I personally believe in the value that DMAR gives, but it's only going to give you as much as you're going to take from it. And all of these things are tools to help you kind of succeed. So some of the marketing that Nicole was referring that I do is basically copy this information. So you need to leave the DMAR water tag, and we prefer that you do the hashtag DMAR stats, but you can absolutely put your information on here and say, hey, every month, look what's going on in the market. Hey, Sphere, hey, marketing, look what I'm doing to kind of show you where everything is at. And as you can see, March, again, these are really more pre-quarantine COVID numbers. Everything was pretty much on the up and up. So even though active inventory was going up, so was the amount of closed houses, so was closing price, so was the median close price, and days on market was going down, which all reflect a really hot market. So again, how to use the report. All DMAR logos, watermarks, sourcing, copyright information shouldn't be removed, but you 100% can put on your own information as well. You can use it for your CMA, for your website, blog, social media, and video. And if ever there's been a time that's important for you to do that, now is the time. I am a terrible millennial and I don't really understand technology incredibly well, but I know that I've downloaded the app Canva. And that is allowed me to use the infographic and kind of put my own logo on it in probably the easiest way. Likewise, I think kind of using PowerPoint has also been working pretty well for me. So again, you can get additional information from city and county reports. RE Colorado, InfoSparks has great information. And of course, NAR, Car Trends Report, and Google Alerts does give you some information as well. So this is not in our market trends report, but there are normally some things on the website that for the digging deeper, but also we wanted to provide value for you for signing up for this market trends report to kind of dig deeper into some numbers. So you can see the average price reduction of listings during this time, and these were just properties sold in March of 2020. And as you can imagine, houses over $1 million, the price reductions were quite a bit bigger than the rest of them. It's somewhat proportional, right? Because the $100,000 to $200,000, $10,000 is 10% or so, whereas over $1 million, $116,000 could have been 10%. Also hard because there's not exactly a threshold over that $1 million on which that's evaluated. So you go from 500 to 4.5. It's a $500,000 price reduction. The percentage of properties sold in March that reduced their asking price was 22.3%. So that was actually less than in March of 2019, which was 27.6%. The listing that had a price reduction spent on average of 83 days on the market, whereas there were 75 days in March of 2019. And then that listings had no price reduction, spent on average about 14 days in March. That was 15 days. So that was pretty close to being the same. This is another one and I believe this is on the website, on DMAR's website, and we're going to click through before the end of this for me to kind of go through. But I really like some of this information because, again, it kind of validates what day to put your house on the market and things like that. So does it matter which day of the week you put your house on the market? The answer is yes. From this listings that sold, the most popular day was Thursday with 34% of the listings. The least popular day is Sunday with 2%. And then average days on market also shows that your lowest days on market, if you put your house on the market, was on Thursdays. The thing I'm always curious of is, depending on the syndication, it used to put your house on the market on Thursday, so that way it's syndicated to like the Zillows and Trulias on Friday. Now, since it's more immediate, I'm still kind of curious if those numbers will change. But either way, you have 59% of the houses hitting the market on Thursday or Friday. And then if you combine Wednesday, Thursday, or Friday, that's obviously the majority. So I know when my clients on Tuesday are blowing me up, hey, what are we going to go look at this weekend? I always put them off until Thursday or Friday because that's when the most amount of new properties will hit the market. And if they're somewhat annoyed, because I think when you tell your clients, like, you know, they're ready to go on Tuesday and you say, hey, just be patient, it never sounds good. But I think if you can show them this graph and say, hey, you know what, I'm roaring to go as well, but we just should wait until Friday to look at everything because so many more houses hit the market throughout that time. And here's the data to prove it. Likewise, the change in prices don't change as much when you list on a Thursday or Friday compared to the other days of the week. Denver's historical appreciation is essentially 6.6%. It's 5.96%. And you can look from 1990 until 2019, where we have the numbers for essentially appreciation. There have not been a lot of years where the market has taken a dive. Obviously, 2008 was the big one. Everything else, 2%, 2.5%, 1%, is very small relatively. And this is where, when I think about, if you have anyone who's thinking about getting a rental property, I think now is as good of a time to get a rental property as any, because interest rates are low. And, you know, the model that you're looking at for a rental property is really for a long-term wealth building tool. And the way I like to think of it is, let's say you can have an interest rate at 4%. So if Denver appreciates at 6%, all of a sudden this lender is giving you all this money that you're paying 4% on, and you're making 6% off of that lender. So you're making 2% off of someone else's money. And that's not including the fact that you're also making 6% on the property as a whole. So you are using that leverage. But appreciation is essentially the same concept as compound interest. It is something that will kind of consistently go up and proportionally have you building that wealth. And I would say the difficult part for people to kind of wrap their head around, especially for rental properties, is because price points are pretty high, it's really hard to cash flow a lot of money. You know, if you're getting $400 a month above your mortgage, at the end of the year, that's $4,800. Something always goes wrong. So instead of $4,800, you end up with $2,000 or $3,000. $2,000 or $3,000 probably isn't going to change your life. But when you think about the fact that you get to write off depreciation, your interest, someone's paying off your mortgage, and then the big one is that appreciation. To me, that is one of the best ways to build wealth. And so, you know, like I think in real estate, there's always that opportunity of, you need to know how to market yourself. You need to know what to do once you have a client, and you should learn how to build wealth yourself. And I think that's something that people kind of come in a little short on, but all the data is there to kind of prove that it's a great opportunity. So this graph is awesome for two reasons. One is, if you can't tell, the colors are orange and blue, so we have Bronco colors. The second is to show the historical average versus what would happen if we went in at a 5.96 or 6% appreciation, and the numbers line up very closely together. So again, from 1990 to 2019, you have all of this data that shows that appreciation, if you hold your property long enough, absolutely will appreciate in a really positive way. And then likewise too for the average sales price in 1990 where you're under 100,000, and then you go to 2019 where you're almost at 500,000. So again, really strong numbers that again help validate why investing into real estate, whether it's for yourself or as a rental property, is really, really smart. The median seller tenure in homes have gone up since 1985. So in 1985, it was a little under 5 years. And then you can see that while things ebbed and flowed a little bit, it's never quite been as high as it is today, where people are just staying in their houses longer. And I think that does create a lot of opportunity. Nicole will kind of talk about on her part, all the built up equity that's currently in place for homeowners. Likewise, like family households and the size of them per household has obviously changed as well. So family households versus all households, that number has gone down slightly, which I think kind of makes sense just with cultural changes throughout time. Likewise, so what are we seeing for showings and how is COVID kind of impacting everything on weekly averages? You can see, and I think we probably are inundated with so much information right now. It's hard to truly decipher all of it, but basically showings are down from everyone I talked to from this data about 50%. This is kind of where I wanted to go off on my tangent, which was I find it very hard. You know, I hear everyone kind of projecting on saying, hey, we're going to be fine. We're not going to be fine. This is going to be terrible. You know what? I think we can get through it. Are we in a U or a V curve? You know, all these things kind of thrown out. That's honestly overwhelming. I listen to podcasts and I get a little like upset by the information because it feels like so much. And so like what I just want to say with the data here is it's really meant to be a tool for you to follow and be able to make your own conclusion. And that I think we're really not going to have a lot of truly valuable information. And again, this is just my personal perspective for probably 6 months. And the reason why I say that is it'll be really interesting in May. We'll get all of April statistics and we'll see all those April numbers, which will really show how the quarantine is impacting everyone. And that'll feel nice, right? Because we'll say, okay, well, we knew the showings were down. We knew that this is the relationship compared to how it normally is. And it'll be a really nice talking point. But then at some point, you know, knock on wood, sooner rather than later, we're not going to be quarantined anymore. And in my mind, it's really going to be a completely different market than quarantine market, right? Because people will not be as scared to go show. It won't be illegal for us to go show houses. And so then once we're not quarantined anymore, we're going to have to go and find out all the statistics on how are things looking once we're not quarantined. And I think the thing to remember with all these stats is everyone is on a 30 to 45 day delay, basically, right? Because if you go and you start looking for a property May 1st and you go under contract May 1st, well, you're probably not closing until June. And then those numbers aren't reported in June until July. And so to get all of that information, you have almost a 2-month delay. So from the time, you know, we'll get those quarantine numbers and then we'll say, okay, well, this is where we're at. And then at some point we won't be quarantined. And then we're going to have to wait another 2 to 3 months to kind of figure out where we're at. And there's always quite a bit of ebb and flow in the market. I always say 4th of July is kind of the end of the buyer season. And again, what that reflects is, okay, those August numbers, that has a fair amount of closings. But that's because they went under contract in that early July or sometime mid-July, because at some point people generally go back to school and things of that nature. So that is, I believe, my part of the market trends for the slides. The one thing I wanted to show just really quick is where to find the market trends report. So if you go to the DMARRealtors.com, I'll try to make my screen bigger actually first here. Okay, maybe I'm not going to do that. So click the Market
It's big
Trends
enough.
tab. Can you see it all right, Nicole?
Yep, I
You
can.
click the Market Trends tab. This is kind of what comes up, and then you scroll down, and here's our Market Trends report. So you can click on that.
Mhm.
Brings you to this screen, and then you go to download the report. And then you got to go to download the report here. And then this is where it pops up, and you can see all beautiful 29 pages of the Market Trends report in very nice graph forms. And really shows you, again, what everything that we just discussed was. But again, I just wanted to show that to you so you could see how to actually get there.
And Andrew, one of the questions was the days on market. I've been able to answer some of the other questions. Obviously, everybody loves the digging deeper. We love the digging deeper. That's our neuroses for the data. We go through a lot of that. That historical chart and the graph we just created. And some of this comes from Steve Danilou. Some of it just comes from our digging into RE Colorado data. But one of the questions I don't know how to answer is the days on market. The question was, is the days on market from active status to closed or pending?
I believe pending.
To pending.
Yes. And I'll text you while you're up, but I'm fairly sure it's pending.
Somebody else agreed that it was pending.
Get their name down.
Yeah, you could double check.
Yeah.
All right, so we're about 51 minutes in. We can jump on in by raise of hands. Let me actually, hey, Andrew, can you unshare your slides?
Oh, yeah. Sorry, I was just having so much fun.
I know you were.
All right.
Oh.
Where is my Zoom? Oh, I got it. I might have it.
There should be a little green or red tab at the top of the share screen.
There we go.
Yeah, there you go.
Promise it's not my
So really quickly, do we need a 5-minute bio break phone call, or do we want to keep going? So if you raise your hands, if you do want a 5-minute break, we'll take that. Okay, just a couple people. Well, we'll keep wrapping. Why don't we take a quick 5-minute break? I won't start the presentation. That way everybody can get up, but we can also unmute yourself if you want to have any conversation with Andrew about any of that data. You know, one of the things, if you take one snapshot of the market trends report and you just read through it, it's kind of an interesting view of the data, and it's a lot of data. It's a lot of data. It wasn't until I started looking at the data month over month and I started zeroing in on the things that I wanted to see. As a lender, I look at very different things than you guys do. And I look at the broad market. I never look by neighborhood or by zip code or anything else. So once you start identifying what is it that speaks to you in a way that you can communicate more like that advisor, you know, going back to what we were talking about in the beginning, there are so many disruptions and there's so much noise. Giving you or taking really the data that is meaningful to you and communicating it in a way that you can continue to add value and have conversation is, I think, what differentiates you from all the noise.
Yeah.
Whatever that noise is. And so it's just watching those trends month over month, season over season, where you start to become more aware of that data versus just looking at one month in and of itself.
The storage place right now.
Go ahead.
But it's, you know, the wire is there. It's literally just in Wells Fargo. You know, Wells Fargo is in.
Hey, Andrew.
So they have to.
He's on the phone. I think that's hilarious. He
I
shut off his video, but not his audio. One of the things, and we're just going to give it just another minute or two, is I was just actually reading an article this morning, and it was talking about showings being down because I was doing this virtual showings technology training this morning, and it said showings were down 88.5%, which did not include the virtual showings. Virtual showings are up quite a bit, but obviously you can't necessarily track those by area because they're on the internet. So it's a little bit of a different, you can start tracking hits and views and that kind of stuff. But another thing that was interesting to me is that there was 919 listings this last week come on board. So we're looking, when we do the market trends report, we're looking at data from the last month. So April 1st comes out, we grab the data. The second day, we translate the data. And then the third day, the third business day, the email goes out to the DMAR 7,000 agents. And so that's the data for the month before. And typically in any normal market, that's good information. Like I could do information 1 month at a time. In this market, it's week by week, day by day. It's changing so rapidly. But that 919 listings in the last week, if you capture just that data and you go back and you kind of start to have a vantage point on how many listings are coming out in the DMAR area, that's normal for a winter market. So that's not that far off. Now it's down for a spring market. So we're off from where we want to be, but it's normal for a winter market. So to see those numbers, you can put it into perspective and go, okay, so real estate isn't absolutely coming to a stop. It's slowing down dramatically, but people are still doing virtual showings. Sellers are taking pictures or doing videos of their homes, or homes are vacant, or whatever that looks like. But there are listings coming on the market. So that's kind of what I was trying to get at in the beginning. I talk a little fast. I'm from New York, so I apologize for that. But that's that whole differentiating yourself inside a noisy market, because all of this is going on. You have to be aware of how to capitalize on the technology, but then zeroing it in on how the data supports your being the expert in that niche is really where the data gets exciting. At least, you know, for those that kind of geek out on it. I think we've got almost everybody back. One person I'm waiting on as I'm looking at faces. You can look at faces when it's a quaint little crowd like this, not at all like last week. You're just in there scrolling through. All right, so we've got one person missing. We're gonna go ahead and get started. She'll catch up quick. Let me share my screen. And then when Andrew comes back on, oh, somebody asked, RE Colorado is now providing a weekly market report. Can we speak to where that can be found? I personally will wait for Andrew to come back online. Not being a realtor, I don't have access to RE Colorado. Hey, Andrew, can you answer this last question before I get started?
On the
weekly reports.
You know, I'm not entirely sure, to be honest. I know I'm sure if you log into RE Colorado, it's probably there. I'll search for it and at the end of your presentation kind of talk to it. But I know that I haven't been looking at it too closely, somewhat for a reason, because whenever we're using the information, it's still somewhat in such a small bubble that I'm not sure necessarily what it's actually reflecting. You can't compare, if you were to compare March 1st to March 7th, you need to compare March 1st to March 7th of last year. And things like that, but I will certainly look for it and kind of comment at the end of your presentation.
Very good. All right, so let me share this then. Okay. So here we go. Let me actually get it back here. All right. So where we go from here is the lending side. It's the give yourselves the anxiety medication, because it's behind the black box. So what all is going on in my world? I'm going to talk a little bit about mortgage lending, but I'm going to talk more about the economy that's underlying our mortgage industry, your real estate industry, everything that we're working with our buyers and our sellers. I'll talk a little bit about COVID, obviously, the recession, but I want to kind of just start out with some fundamentals. And these don't change, even though a lot of this presentation has changed a lot in the last month and two because of everything else that's changing. But so the underlying, I want to talk about the role of the Federal Reserve Board, the stock market's impact on bonds and the trade there. That what has our interest rates been historically and where do we forecast them to go? Looking at appreciation, affordability, and then we'll jump into kind of the current recession talk and economic trends with COVID. So the Federal Reserve Board specifically, and if you ever listen to Federal Chair Powell, I will tell you, if you're at all interested in this, every time they have a meeting, and the last couple meetings have been quite odd, because the last meeting they actually blew up. They had the meeting on Sunday behind closed doors. They came out with the announcement that they were dropping the Fed rate to 0. They didn't have their scheduled meeting, which was only 2 days later, mind you. There was really no reason to have an emergency meeting 2 days before and create kind of the buzz that they did. And what they did is they actually sent a ripple through the stock market, because it looked like they were in crisis mode when really they were scheduled to meet just 48 hours later anyway. But they have two primary purposes. Every time they meet, Powell comes out and talks for about 45 minutes. If you're going to watch anything, and if you have any interest of seeing where they think the economy is going, watch those 45 minutes. They only do this 10 times a year, and it's always at noon Mountain Time. So you can watch it. They have a website, they have a countdown. It's on YouTube as well, but they do their 45 minutes talk, and he'll always refer to his two mandates. And that's keeping the prices of things Americans buy stable, i.e. controlling inflation, and then creating labor market conditions that provide jobs for all Americans who want them. So maximizing employment, minimizing unemployment. He will say that all the time. He'll constantly say, we've decided to do these things, these mandates we put into place based on the fact that we are controlling the cost of things or inflation or unemployment. He circles back to that. That's their two mandates. So you'll hear that a lot. So it's really important to understand that. So when I look at what is he looking at, they're looking at two indicators for inflation. And I want to just make sure that you realize that there's two, because they're used interchangeably. And if you don't understand the difference, they can be quite sizable. So the PCE is what Powell talks about all the time. It's more the business industry perspective on inflation. What is the cost of things as they're going up from a business expenses? What's the cost of medical care as it relates to the premiums paid by the corporations and the employers, not the people? So it is absolutely from a different vantage point. So it's looking at the consumption, which excludes out-of-pocket, smaller expenses that more weigh on housing. And then there's two different PCE numbers. One is core and one is headline. You'll typically hear core quoted because it takes out oil, gas, and food. Oil, gas, and food, if you look at the little red dots, they create a lot of variability. Obviously, what's going on right now with the oil war, kind of, if you will, the price war, that's creating a lot of volatility. You might have something like bananas might get infected, and whatever happens with food, all of a sudden you're going to see volatility, whereas the traditional inflation is not going to move quite as rapidly. So we're looking at core. The other index for inflation is the consumer price index. And you don't have to kind of remember all this stuff. It's really geeky, and it really doesn't even matter, except for the fact that they always quote PCE, yet us as individuals feel consumer price index. That's our cost of housing, our cost of medical, our cost of gas. So it's what's coming out of our pocket, and it's always higher than the PCE, because Powell will say, well, inflation's under control. Meanwhile, we might be feeling something very different. So I'm always looking for the CPI numbers, the consumer price index, as I'm talking and relating to consumers. The other thing he's looking at is unemployment rate. So that just jumped, as you guys know, from 3.5 to 4.4. And with everything that we've just heard with the jobless numbers, you're thinking 4.4 doesn't even start to grab what it is. And you're right. And I'm going to go into that when we talk more about the effects of COVID and this recession that we're in. I'm going to stake the claim on that one. But for right now, I'll tell you that unemployment is tracked monthly. So this number isn't going to track as fast as the jobless claims. Jobless claims are tracked weekly. So this is tracked monthly. And so this is looking at right now, what are we in? We're in April. So this is March. And it was specifically the unemployment the week of March 12th. So like right now, we're at April 14th. So 2 days ago was Sunday. So Sunday was the 12th. So all this week, they're phone calling people to find out if they're employed or unemployed or underemployed. And it's those phone calls that go into this consolidated data collection that turns into our jobless claims and turns into unemployment. So that was done a month ago. So that's where the 4.4 number comes in. They're doing the numbers for April right now. So by the time we get the numbers on May 1st, they're already 2 weeks outdated. And in most worlds, that's okay. The world we're living in right now is the one where it's not. It's moving much, much faster. So the Federal Reserve Board dropped the Fed rate. You guys saw that on the news. I sent out a lot of videos to my group about that. They dropped it first. They had been raising it. We had had a healthy economy. Now, I don't want to say we had an extremely strong economy. We were heading towards a recession anyway. We already had numbers like shipping and manufacturing and underlying economic numbers that were showing that our economy was starting to weaken. But it didn't matter because consumer wages and consumer spending was still up. And as long as jobs were up, wages were up, and spending was up, consumer spending is 70% of the GDP. So the GDP is a measure of the health of an economy. And so for all intents and purposes, the economy was still going through this expansion process. Meanwhile, underneath the manufacturing, the shipping, the core of industry was starting to slow down. We're not an industry country, we're a services country. So we're more focused on consumer spending. So we were starting to see that Fed rate was climbing up. It had been zero through the whole entire previous expansion. So we were finally climbing back out of that. And then they dropped it from 1.5 to 1. They did that very quickly, almost too quickly upon finding out that COVID was out there. And then they dropped it from 1 all the way down to 0 on that Sunday, 2 days before the scheduled meeting. Because of everything that's going on with the Fed rate and the federal funding that's happening, the printing and burning of money, if you will, there's a lot of money that's being sourced and sent out to support businesses, individuals, corporations, what have you. Because of that, the stock market and the bond market are not moving as they should. How they used to move, and they do on spurts, but a lot of this fiscal policy today is kind of skewing the numbers. But typically what you'd see is when the stock market is rallying, our bond prices go up, which means our interest rates, no, I take that back. When the stock market is rallying, our bonds go down and our interest rates go up. Sorry, I said that backwards at first. So, I'd always joke with my husband, I can't win in my retirement accounts and on my job. So if the stock market is rallying and I'm doing very well in my retirement accounts, my interest rates are also going up. So I have less people that are asking about refinancing or maybe purchasing based on lower interest rates. So, and that happens because when the stock market is rallying, people are pulling their money out of the safety bonds and putting it into the stock market. It's creating a supply and demand offset, which affects interest rates, which is the premium to buy bonds, is really all that is. So there can be an effect where we're watching this, but right now it's not quite working. And what we've seen in the past is that has impacted our interest rates, which we have been blessed with this last decade with extremely low interest rates. So going through that, in the 1970s, we saw 8.8 was the average decade interest rate. It went up to 12, back down to 8, 6. My first house was at 8% interest rate. Anybody older has some great stories. This last decade, the average interest rate was 4%. By the time we get done with this decade, it wouldn't surprise me if it was 3.5 the way things are going. Interest rates today, Freddie Mac is one of the websites I track. That's a national survey is all that is. So it's actually a data collection by survey of lenders across the country. The problem with this website, Freddie Mac's website, is two things. One is all of their rates have a point in them. It just doesn't explicitly say that. It'll be anywhere from 0.7 to 1 point to get that interest rate. The other problem with this particular website is it's always a week old. So it takes time to collect data on a massive scale. That's why, like if you look at our DMAR numbers, we always have numbers, literally the first we're collecting the data, the second we translate the data, the third we put it out for that previous month. If you look at NAR data, national data, data collection on appreciation, it's always 2 months behind. because it takes that extra month to gather it. Same thing with Freddie Mac, but interest rates have been low. Even just this week, it's Tuesday. Even this week, we've been locking in interest rates at 3.25%, 2.875 on an FHA, 3.25 on conventional, 3.99 on investments. And those are, I mean, it's so varied based on a particular scenario. I'm just kind of giving you kind of a broad stroke. Rates are still low. They're just still phenomenal, and giving people the opportunity through improved affordability to get into real estate. Historically, if I look at interest rates, I'll still have people that are saying, well, I want to wait until the interest rates drop. And I go, 3.25 is not low enough for you? And they're like, no, well, I heard it had gone to 2.99, so I want 2.99. So I always bring this up because historically I show them, so the lowest point of interest rates in history since we started tracking interest rates was November 21st, 2012, when the 30-year fix dropped to 3.31. Now, remember, that's, you could easily buy it down, and people were dropping down to 2.99. So it's a bit of a relative situation, but we had hit on March 5th, and that's when everybody was locking in at 2.99, 2.875 even, 2.75 with a half a point. We were locking there. The 30-year fixed tracked Freddie Mac rate was 3.29. So it was actually lower. It had become the lowest point in interest rates in history. So, and I don't know if you guys remember what happened on that day, but literally the next day, the rates popped up by a half a point, a full point, sometimes more than that. If you went to an internet and Googled interest rates, you saw a lot of lenders even removed their interest rates, removed all ability to even apply for a loan because banks got overwhelmed. There's $11 trillion in mortgage debt out in the United States right now. And on any given year, 1 to 2 trillion turnover due to refinancing or purchasing, what have you. So 1 to 2 trillion turnover on any normal year. We had anticipated that we would see 5 trillion come through this year based on the low interest rates and where we were headed before COVID-19. Well, it literally felt like all 5 trillion were trying to come in on that one day, and it blew up the system. And you'd see the major banks, the Wells Fargos, the Chases, you'd sit on hold for 5 hours. The small banks were trying to keep up as quick as they could. And then eventually they just stopped taking loans. I had heard, Belco, TCF, First Bank, a number of different banks just said, we're not doing any more originations starting now. And we even got, some of those coming over to us. And even we were slow on the go for a day trying to keep up. But interest rates are phenomenally low, which provides that ability to get into a larger home than you could even a year ago. One of the things that we look at really quickly on appreciation, so the DMAR Market Trends Report will show a number, and this is one of the things I absolutely look at, is the year-over-year median year-to-date sold price. It's our version of appreciation. It's a bit sloppy at best, but it shows general trend and direction. So I continue to watch this month over month and year over year. And I use the year-to-date because it levels out seasonal changes. So as you go through the year, you're going to start to get a grasp on where we're headed this year. This year, we came out of the gates extremely strong. Last year, we never even hit 2.5% year over year median year to date sold prices. And that's just, are those median prices going up or going down? Last year, they scooted along the bottom. It was 2.5% for the end of the year. This year, at February, only 2 months into the year, we were at 6.25% gain in median year over year, year to date sold price. And in March, we had popped up to 6.75. So which totally made sense. The first half of March was still off the charts. The second half of March, we just saw some of that growth slow down because of COVID. The difference in this and appreciation, so there are two major data collectors. There's a number of data aggregators, but FHFA oversees, and you guys are probably hearing about FHFA more now than ever before because the director Calabria is making some decisions that's absolutely affecting servicers and affecting our ability to lend loans. But FHFA oversees Fannie and Freddie. So their data aggregators are looking at all loans under the conforming loan limit, so no jumbos. Now, this does also take into account the Govy loans, the FHA, VA, USDA loans, but it's only going to be conforming loans. If you own your home outright, you're not going to be in this data set. Or if you're a jumbo loan, I mean, you could be $1 million home with a $400,000 loan amount. We're going to see the appreciation state by state. They even have it by zip code, and they have it by country. CoreLogic is the other one, and they look at all of the homes, including jumbo, and their numbers are always off. But at last time of this report, remember they're always off a couple months, they were seeing that the United States as a whole was growing 5.2%, and Colorado was up 6.4%. Which is phenomenal growth compared to what we saw in 2019. Remember, the historical national average of appreciation is 3.6%. So doing very well coming into this recessionary period. But we all know real estate is hyper-local. Steve Danilo is on our committee. He does a phenomenal job. He puts this report out once a month. This report is he doesn't put it out once a month. He puts this report out once a quarter. So he just sent this out at the end of last week. I'm not even sure if it's on the DMAR website yet, but it always goes on the DMAR website. So that same place that Andrew showed you where you can get the market trends report, you can also get Steve's zip code report. And I'm happy to send this to all of you guys as well afterwards. But it's a great, he does it once a quarter, as I mentioned. This is something you can certainly do with RE Colorado in zip codes that you're identifying. And this is that whole thing about, grab what works for you in this market trends report. Grab the data that you like, start tracking it, go to RE Colorado, create a report where you can start to see this data on a more regular basis. But this one was really cool. One of the things that he pulled out of this is, yes, we are seeing a drop in closings. In 2019, just 1 week, the end of March, we saw 1,364 closings in 2019, 1,249 closings in 2020. So that was an 8% drop. The first week of April, we saw a bigger drop. It went from 981 in 2019 to 713 in 2020, which was a 27% drop. Just him going through RE Colorado and disseminating that information. Case-Shiller is also one of the ones. CoreLogic and Case-Shiller are neck and neck in the data aggregators, the space. They both look at the national data. What I wanted to kind of show on here, they did show the 2008 drop in prices, right? We lost a lot of value during that. But this light blue line at the very end, they are not seeing home prices depreciate coming into where we're headed. Neither are the other data aggregators. So Home Price Expectation Survey is 100 known economists. Mortgage Bankers Association, Zelman and Associates is a top-notch consulting group and data aggregator for real estate. Fannie Mae, NAR, and Freddie Mac all show appreciation gains over the next 3, even 5 years. Home Price Expectation Survey goes out 5 years, and it's all positive. None of these are rock star. I'm not seeing like an 8 or a 10 or 12 on this chart, but I'm good with that. Like, I'm totally good. If I own property, and I do, like I mentioned earlier, I own 23 investments, and if I continue to gain value, even at 3, 4, and 5% year-over-year appreciation through this, while I have renters paying down my debts, and my tenants, a lot of them are still paying rent, that's a win-win. So we're continuing to see appreciation. So that's the conversation with our buyers and our sellers right now, is how do I take this data and communicate in a way that helps them make a decision, right? Getting them off the fence, because people are like, well, I'm gonna wait and see. And I get it. If you're one of the people that don't have a job right now, you have to wait and see. You can't jump in when you're protecting your family and your liquidity. But if you're one of the 80% of Americans who do have a job, because we're expecting unemployment to go to 20%, maybe 30, that's still 80% of people that are gainfully employed and wanting to take advantage of continued appreciation and low interest rates, helping them get into the real estate market. And of course, life continues to happen. I've got 3 kids in college right now. The oldest is graduating and he's going to move and he's going to need a house. And yes, I know he's got less houses to look at, but he's going to need to get settled. So, that's life continues. So factors of affordability really quickly, because this is a conversation that occurs constantly because Denver is seen as unaffordable. And I do get that, but our wage growth has actually been pretty phenomenal. We were the second highest state in wage growth, second only to Washington State. Now, of course, that was before a lot of people lost their jobs, and I get that, and that's very sad. But looking at the base numbers, we came into this with extremely strong wage stability. So yes, our home prices were appreciating and they were appreciating pretty rapidly for a while there, 12%, 10%, 8%. But our wages were increasing as well. And people will say, well, the wages weren't increasing at 12, 10, and 8%, but they don't have to. Because if you think of a loan is only on a percentage of a home price, and that loan payment is only a percentage of that divided by 12. So the actual impact of that growth of appreciation, when you actually nail it down to a monthly number and you compare it to the wage growth on a monthly income base, then the wages were keeping up with, and I can pull out the numbers for that, and I won't do that right now. But the wages were very strong here in Colorado. If I take a home price, so if I look at right now through March from a year ago and my affordability levels, so if I take a home that is going to now cost 6.75% more than it did a year ago, and I start out with a home price of $415,000, so really close to our median purchase price, and I take interest rates that are 0.85% lower than they were a year ago. Because remember, interest rates were at their high in November of 2018, and then they started to fall off, but we're still almost a full point lower than we were a year ago. And our wage growth before COVID we were up 5.2% year over year. Now, a lot of that wage growth was in the lower wage set, right? So your entry level salaries and lower level management. But overall, we had considerable wage growth coming into this. So that is an increase in purchasing power. So I can actually afford a home that's almost $40,000 more than I could have a year ago, yet that home has only increased $28,000. So there is a difference. It can get me into a higher bracket of home prices. So definitely there's a couple of reasons that you want to have a really good relationship with the lender that you're working with. One is, given all of the changes, the guideline changes that are happening right now in response to the liquidity issues and everything that's going on with COVID, you want to make sure that your buyers, if you have any who are online looking at homes, you want to make sure that you're in communication with the lender, that they've reapproved them and that they're secure in their approval going forward, given guideline changes, but also reapprove them when it comes down to what can they afford. They very well, if they still have a job, very well could afford more of a home than they could before. And then of course you have the benefit of there aren't as many multiple bids going on right now, so might be able to get that person into a home and take advantage of some of the opportunity that this market is giving us. So let's go into the recession really quick. Andrew, I don't imagine there's no questions that I need to jump in on. You got it?
Nope, there are a few questions. Actually, I just wasn't sure to wait or not, but I'll just shoot some at you now if you're okay with that.
Yeah.
All right, I'm just going to read them off. So Brandy said, economists and lenders are predicting that at some point this year, we will see historic low mortgage rates at 3%. We're also hearing that the economy will be bouncing back in Q3. I have buyers that are ready to hit the market as soon as regulations are lifted, landing us in Q2. What do we anticipate it will look like in terms of interest rate and inventory as soon as we begin in-person showings again?
That's a great question, because we are hearing a lot of conversation about Q3, because there is going to be this extreme hit to Q2. Q1 is going to take a hit as well, because we just finished that. And March kind of threw us for a loop, the second half of March. So we're expecting the GDP for the first quarter of 2020 to be just under zero, maybe -2. But the second quarter is going to be low and the third quarter is supposed to be positive. So we're supposed to bounce back, not nearly as high as the loss, but as people go back to jobs. So where will we be second quarter? Great question, because it's kind of this unspoken quarter right now. So interest rates already are 3.25, right? Will they go to 3? They could. I'd be happy with 3.25, and I can sell that all day long, because the difference between 3.25 and 3 is just so minimal that getting that person into a home with that kind of a rate they're never refinance that loan again. But where we'll be as soon as we come out of this, we have to get out of this unknown. Right now, we don't know where servicing is going to go. We don't know if FHFA is going to stand up and back conventional loans like Ginnie Mae is backing government loans. Ginnie Mae oversees the insurance for FHA, VA, and USDA. They already came out and said, we've got your back. Like servicers, because when servicers are, and I'm going to get into a whole forbearance conversation, when they're not collecting mortgage payments, they still have to pay investors, property taxes, mortgage insurance, and homeowners insurance. So all that to be said is, as soon as we have the box defined and we know what risks we're up against, then the market will settle. Then you'll start to see some of these extreme guidelines that are going into place right now pull back towards normal. And when that happens, you'll see people will be able to put in an offer, get closed in 3 weeks, know what the guidelines are. Some of the programs will come back. Some of them are going to take longer to come back. But I expect that interest rates will be in the low to mid 3s for quite a while. Could bounce down to that 2.99 on occasion. Will it sit at 2.99? That hurt the industry. It really did. And realistically, if I were to loan you $300,000 and I was only going to charge you 2.99% for the next 30 years, the problem with that is money will cost more down the road in 5 years or 10 years. And yet I'm locked into only getting a return for 2.99. So it's not super advantageous to lenders as a whole to keep it that low for very long. You'll see spikes and drops, but overall, we'll see a healthy financial market as well as a very healthy real estate market as soon as we pull out of this.
I got 3 more for you, if that's all right.
Yeah.
Next one is how recent in your home price projections info? How recent is that information?
The home price, the going forward. So the minimal, the data aggregators that we're looking forward, that's all been within the last month. When I'm looking at what was the appreciation from FHFA and what was the estimated appreciation for CoreLogic going forward, those were January numbers, regretfully. The February numbers won't come out until the 20th of this month.
Great. 2 more. And can you confirm that you said the FHFA chart excluded, as in not included, jumbo loans and homes that are paid off?
That's correct.
Correct. All right. And then last one was, has liquidity evened out, and is the Fed going to backstop lenders and servicers that are caught in the lurch?
So no, it hasn't evened out. It hasn't fixed itself yet. Having said that, so it all comes down to FHFA's director, Calabria, has said that he's waiting to see. He doesn't think it's going to be the problem that everybody else says it is. If we see a 25% of all of the people that can go into forbearance, it will cost servicers $12 billion a month. We just don't no servicer is set up for that liquidity. They're not banks. So they don't have depository accounts that they can offset liquidity with, and they don't have access to Fed funds. So all they have is the intake of mortgage payments. They take their profit off the top. They pay the investors. They pay the property taxes, mortgage insurance, and homeowners insurance. And then they keep the pipeline moving. So they get a small revenue stream from managing, kind of like property managers, collecting rent and paying the landlord. They collect the rent, pay the landlord. They take 8 to 10%. That's exactly what a servicer is. So they're not built to have that kind of liquidity. They never have, and they never will be. So we need, but this level of forbearance was never foreseen, right? I mean, we didn't realize this was coming, and the cart went before the horse a little bit, the government said, with the CARES Act, and they did it in good faith, I'm sure, and they probably knew that some of this hasn't been worked out yet, but they said, we want to give all this and take care of the Americans because we're keeping them at home. I get that. Just make sure that we have all of the systems in place to support the very banks that need to provide that kind of ability to forbear. So government loans have it, the conventional loans do not, and the jumbo loans never had it. And so jumbo loans and first banks and portfolio banks, non-QMs and brokers never had that kind of liquidity access, which is why they all but shut down. There's very few, if any, non-QM products, very few, if any, jumbo products, and very few, if any, lenders that are doing down payment assistance right now, because the riskiest products didn't have the backing of the federal government. And there's a lot of people that are reaching out to FHFA right now to get that in place. I'm hoping that maybe by the end of this week, we'll have somebody step in and make it happen regardless. I know Powell wants it. I know that the Treasury Secretary wants it. And I know that MBA and NAR want it. And they're all trying to get FHFA director to change his mind.
Awesome. All right, last one, and then I can hit the ground running again.
Yeah.
When will FHA begin to lend again?
Oh gosh, FHA's lending. So we're doing Fairway Mortgage is doing FHA loans down to 640 credit score. We're not going all the way down to 600. Different lenders did it differently. Again, if you think of everything from the perspective of risk, you start to understand why certain products went away. So down payment assistance and CHFA went away because you have people that have absolutely no equity. So the risk of them going into forbearance is extremely high, and they have nothing to lose. So they'll just walk away from the home and it'll create foreclosures. So not only is their risk of forbearance and foreclosure higher, but also CHFA and MMA and the other down payment assistance programs are notorious for taking about 43 days on average to buy a loan. So if we originate a loan and it's sitting on our warehouse line, it takes them that long to buy it. Right now, we need the warehouse lines to turn over as quickly as possible so that we can support the loans that we've got and the servicing backup. And so the CHFA loans are just creating an undue stress on the entire system. So that's why a lot of lenders are putting a pause. They're not gone. There's just a pause on accessing some of those programs. FHA is still here. Ginnie Mae is insuring the servicers. Some lenders might not be doing it because it's risky, the same way Fairway isn't doing some other things because it's risky. Every lender has to look at, Chase just made their sweeping announcement on Saturday of what they're not doing anymore, which is massive. So every bank and every lender has to look at what their ability to absorb risk is right now.
Perfect. Thank you.
Yeah. All right. So continuing the conversation around recession. So we had been in the longest running expansion on record. I often joke about this and I'll say it again. A recession is like milk, right? It's not like milk. It doesn't have an expiration date. So although milk expires, an expansion doesn't expire just because it hits a date. And if you guys remember, there was a lot of news around when the expansion hit the 10-year mark. And that's because the longest running expansion prior to that had been 10 years, and then it flipped over and we had a recession. That didn't mean anything. We blew past the 10-year mark and we were fine, and we were going to be fine. As I mentioned, the economy underneath was slowing down. We had high debt levels. We had manufacturing and shipping slowing down. We had commercial and industrial loans rolling over, meaning they weren't paying off because the industries didn't have it. And we also had excess capacity. So we had all these things going on from the manufacturing perspective, but we're not a manufacturing country. We're a services country. So that's why it hadn't really stopped us from moving forward, because people were still spending. And as long as they continue to spend, they're 70% of the GDP. But just because we're in a recession, and we are, undoubtedly, not everybody's saying it yet, but when we look back, it started mid-March. And so when we went into this recession, people will say, well, the home prices are going to go down. And one of the charts that I always fall back on is the fact that of the last 5 recessions, and I could go further back and they'd be positive as well, but the last 5 recessions, only 2 of those recessions actually saw any decrease in home prices. The last one is a no-brainer. The recession didn't cause the housing bust. The housing bust caused the recession. So that's the difference. Because we had the housing bubble and the housing bust, we had the recession. So that loss of value was completely isolated to that event. Before that, 1991, we did lose some value, but very, very little, and it was relatively isolated. The one thing that I do want to point out in this, in 2001 and 1980, we actually doubled the historic national average of appreciation. We were up in the 6s. Our average historical appreciation is 3.6. So housing can do very well because historically interest rates go down in recessions. So you have people that you still have people that have the ability to purchase, the 80% that are still working. They're taking advantage of low interest rates, not as much demand, that ability to capture that home that they might have been priced out of before. So when we look back and we see that we were in a recession, because the joke is that, you know, the best that forecasters are able to do is recognize that we're in a recession once we're actually in it. We'll notice that some of the indicators flipped in March. So I see the ISM as a manufacturing index. It's one of them that has been, if you look for the last 18 months, it had actually been on a decline. That's what I was kind of talking about. Manufacturing had already been headed towards a recession. And for a second, it revived itself, and then it dropped again below 50. 50 is just an indicator of a recessionary manufacturing environment. This next slide, I don't know if you guys have seen this. I'm going to see if I can forward. Freddie Mac, actually, Sam Kafer is the head of Freddie Mac, and he did this, or he had it done. I'm sure he didn't do it himself. But this is the weekly jobless claims, and it seems like there were spikes until you look at what has happened the last 3 weeks, and it puts it all into perspective. Because the jobless claims over the last 3 weeks are nothing normal at all, not even close to anything we've ever experienced before. So any of the spikes that we had back in here just don't hold a candle. So what we see now is the fact that we had the largest weekly jobless claims in 1982 was 671,000 in 1 week. Just before this spike happened, in the beginning of March, remember, we were in a strong economy, yes, slowing down, but we're in a strong economy, a phenomenal housing economy, and we had a jobless claim of 282,000. It was low. And then all of a sudden, everybody got sent home, and it spiked. It went to 3.3 million to 6.648, this top number, and then we landed right here. We just came down slightly to 6.6. We're estimating, this number comes out on Thursdays, we're estimating this next number to be around 6 again. And the reason why it's continuing, most people have already been sent home, but there was a lot of states that had technical issues with getting people into their unemployment systems, and that's why we're seeing this carry forward for several weeks at a time. This is a weekly number, this jobless claims, but the headline jobs number is a monthly number. So is unemployment. So the headline job numbers is how many jobs are created. So this number before, this weekly jobless claims, is how many people filed for unemployment, how many people went without a job. The job number is how many jobs were created. We've had a positive 200,000 job number created month over month for many months in a row, somewhere close to that. That 200,000 positive number isn't by itself. It's a combination of a positive million jobs being created and 800,000 jobs being depleted, because you always have companies that start and burn out, close their doors, consolidate, whatever that number is, but you're always going to have a positive and a negative. Right now, we ran at such a negative, and we didn't have enough jobs created that we had a negative 701,000 jobs lost in March. This is phenomenal. So these are businesses that have closed down and or jobs that have been eliminated. There were still jobs that were created. Walmart created 100,000 jobs and had another 50,000 lined up to be created. Amazon hired 100,000 people. Grocery stores hiring. So there's hiring going on, just not nearly as much as the jobs that were being depleted. Those numbers go into the monthly unemployment, which I had showed you earlier, went from 3.5 to 4.4%. And if you're anything like me, you're like, that number doesn't even make any sense. So of course I dug into it. So we have 162.9 million non-military, so civilian in the labor force. So this obviously does not include population who are under 18, over retirement age, disabled, handicapped, any number of reasons why somebody might not be in the labor force, and also civilian. So we have 162.9 million people in the civilian labor force. We were running about a 5 million unemployment. consistently, right? That's that 3.5 number. That's that historic 50-year low. And you always have people that are unemployed for any number of reasons. This 4.4 number is 7.1 million. This goes back to the survey that was done the week of the 12th in March. The week of the 12th of March. It was right before everything happened. And when we saw just the week prior to that, the Thursday prior to that, we saw one of the lowest jobless claims for the week. So this hadn't been picked up. Some people had already lost their jobs, but they hadn't filed for unemployment yet. So a lot of this is a timing game, but it went from 3.5 to 4.4. There's also an all-in unemployment. You might see that as well. That number always runs a little bit hotter. That includes people who are underemployed or taking a different job or several part-time jobs in order to maintain the same income. So where this number really should be, if I include the 3.3, the 6.6, and then the 6.6 again, just the slightly lower 6.6, we're probably sitting at about 12% unemployment. And that number with this next week will go up. So we were expecting that number. Some people are now saying that they're expecting it to land at about 15% and stop. I've heard other people say 20% and other people say 30. 30 is the highest number I've heard of. Obviously, it's extreme. It's a bigger number than we've seen, but it is also going to be a hot, direct number that's going to bounce back. So this just kind of shows, this is from Moody's, and they're expecting that unemployment rate to spike up and then drop down. They're also expecting the job numbers to spike and then come back. Not as much. If you look at this, that employment change is dropping. It's not recovering as much as it dropped. It's going to take years for everybody to get back to work. Some businesses will close and not reopen. Some jobs will have to get retrained, or people will have to go back to school. And some people will just choose to stay on unemployment because they can. So we have to know that it's going to take a while. It could take several years for us to get back to a new normal. And I don't even want to say business as usual, because I don't think it will ever quite be what it was, but it will be different. Consumer confidence is a big indicator of the recession. And as you can see, it absolutely, the bottom fell out. When this number drops 20 points, we are in a recession. It dropped more than 20 points. It dropped 30. So obviously, right? Everybody's at home. Their confidence that the economy is doing well, and they can't even spend even if they wanted to because stores are closed. So the consumer confidence went down. Totally makes sense. We're in a recession. Mortgage applications have also been coming down. Just a couple weeks ago, we had hit a 3-week drop in mortgage applications, both for purchases and refinances. People were in the midst of change. Are they going to keep their jobs? Are they going to lose them? Are they going to be furloughed? What does that look like? So of course, whenever you see that, we did regain some of that because our interest rates after the drop to 2.99 and then the drop of the Federal Reserve actually dropped to 0 after we had the lowest interest rates. It wasn't the other way around. A lot of people will say, well, I want a 0% mortgage rate. I want a 30-year fixed at 0, and I do too. So that's just not going to happen. But we actually had the 2.99 the week before the Federal Reserve Board dropped the Fed rate to 0, interestingly enough. So we did see the rates drop down after we got Ginnie Mae was back on board protecting the servicers. There's some things that had worked itself out. People were coming back in and starting refinances again. But again, those applications are down as people are sitting at home and they're not out shopping. GDP growth rate, the last quarter that was done was fourth quarter. We don't have first quarter yet. We're about to. They're expecting it to be a minus 2.5 right here. They're expecting second quarter to be minus 18%, and then third quarter to come back with a positive 10. So do notice it's not going to rebound point for point. It's going to take a while, but it is going to bounce back. And a lot of people, bars are going to reopen, restaurants are going to be open, sporting events, gyms, all of that is going to start to see reopening. So forbearance, let's kind of go through that very quickly. You guys have heard a ton about this by now, I'm sure. So I don't want to drone on about something that you already know, but I do want to kind of highlight a couple of things. So the forbearance, when it first came out, so really quickly, the timeline on this. So FHFA came out first. Fannie Mae and Freddie Mac said, we are going to allow for a 90-day forbearance. That was actually before the bill came out. So they did it prior to being mandated to do so. And they said that they were going to do the 90-day forbearance. Servicers were already getting lined up to offer that. Then the bill came out saying that we're requiring up to 180 days, not 180 days. Want to make sure that's very clear, because some people are like, well, I get 180 days, and you don't. It's up to 180 days with a second up to 180-day extension allowed. How servicers interpret that and roll that out, it was left very broad in the bill. So, and I read it. I read all of it, and there were some things that were very specific. That was not. So it's up to 180 days with a second 180 days allowed. After that, Ginnie Mae came out and said that they were going to allow for FHA, VA, and USDA, they were going to allow up to 180-day forbearance, and they were going to protect the servicers. So that's the order things happen. FHFA has not come back out and said that they're going to protect the servicers. That's what I'm talking about. Calabria is saying that he's not going to yet. He's going to wait and see. So, which is creating all the servicer liquidity issues. So at the end of the 90 days, because that's where most servicers are starting, they're not starting at 180, they're starting with 90, and then they're coming back and saying, call me back at the end of the 90 days and we'll see if you need it again. The first 90 days is you ask and you shall receive. You just let them know that you've been impacted by COVID and you get it. At the end of the 90 days, this is really critical, that your first and best option is reinstatement, which means that you're able to cut them a check right away for 4 months of mortgage payments. The 3 months you missed plus the current one that's due now. So that's a reinstatement. Or they'll put you on a repayment plan. So they'll take that 3 months and they'll divide it by 12 and they'll add it to the next 12 monthly payments. Or they'll allow you to take the 3 months that you missed and add it to the back. For FHA loans, it's called a secretary's lien. For conventional loans, it's just added to the back, not in months, just kind of like a balloon payment. It's interest is being added onto that, not on the secretary's lien, but on the deferment for conventional. And then the last option is a modification. And that will absolutely impact credit, but that's where the terms are modified. Really clear, none of this is up to the borrower. All of this is up to the servicer. So the first 90 days are a yes. You ask, you shall be granted. The second 90 days, you come back, and if you can document that you are being restricted financially because of COVID, you lost your job, whatever that is, you can request an additional 90 days or 180 days. They're going to require documentation at that point. If you are not being affected and you're ready to start participating in your mortgage payments again, they are going to waterfall you through the options. They want the reinstatement first, then they're going to do the repayment plan. Then it's up to them and their decision of your situation on whether they allow deferment or a loan mod. It is not up to you. So that it's really clear that this is only going to hurt people. They should only take advantage of a forbearance if 100% absolutely necessary. That gap in mortgage payments is also going to follow them for a while. It is not defined yet, but lenders are talking about how they're going to look at that gap of mortgage payments, and without a 12-month mortgage history, you might find yourself in an inability to refinance or purchase for a minimum of a year, if not longer. So that gap of time will impact you in more ways than just having to make up the payments. We will see, regretfully, some loss of home ownership when that happens. On the flip side, we have demand. On the flip side, we have housing growth. Housing formations is growing faster than new builds are supplying inventory. So we've continuously seen that. If you look at the tail end of this is what we were heading into. We had a beautiful 2 years coming up. We really did. And we will get there again. But we had this amazing population gain coming, these household formations. And it was births 33 years ago. So speaking of that, so let's look at 33-year-olds today when they were born. And if I look at this little gap of time right here, you see the population increases back 33 years ago. So that tells me that 8.8 to 9.2 million first-time homebuyers who are coming in the market and expecting to blow us up Well, they're sitting on the sidelines right now, just itching to buy a home because they were born, and we can't undo that. Interestingly enough, if we go back to 2006, the 33-year-olds back then, and if we look at the birth rates, the 5 years after that, that was right after Roe v. Wade. That population was low. And right at that same time, we had this massive supply. We had spec homes, we had builders. We had massive supply during that time. And if anybody studied demographics at all, they would have seen this lack of demand coming. It was coming in a wave as we had less births 33 years prior to that. But that right now, what we've got with the lack of supply and the increase in demand and the continued pent up demand is what's giving us the appreciation. So Adam is yet another data aggregator, phenomenal data aggregator. They do an equity analysis on by state, by area. And so this one is by metro. And you can actually drill down into different zip codes. And I lined up a handful of zip codes. There were more than this, but I just grabbed these. And so 37% of all the homes across America are owned free and clear, no mortgage attached to them at all. So 37% are owned free and clear. 26% of the ones that do have a mortgage have more than 50% equity. So that means 54% of all the homes across the country have more than 50% equity when you include the ones that don't have any mortgage at all and have 100% equity. That's phenomenal equity. So we're going into this new recession, right? It's not an economic recession and it's not a housing bubble or bust. It is purely a pandemic caused recession. So when we pull out of this, we're going to have extreme equity. Now, there are going to be homes that did down payment assistance, have $1,000, have no equity in their home, that they're going to be in trouble right now. But there's plenty of people that have lots of equity that are going to take a look at this. And as long as they hold on to their homes will continue to appreciate. In fact, if I take that home price expectation chart with a minimal appreciation, not the 6% that we're used to getting in Denver, but 3%, 2%, 2.8%. And if I overlay that on the $415,000 home purchase that I talked about a couple slides ago, if I take that minimal appreciation, that home price goes up every single year for the next 5 years. In addition to that, I have a principal reduction. So that green bar is the principal reduction every single year. If I add up those green bars and then I look at the gain over the next 5 years appreciation, I've given my buyer, right, my borrower, your buyer, the opportunity to gain $100,000 in net wealth over the next 5 years. There is no better place than real estate to put your money long term. So that's what we have to make sure that we're communicating with our buyers, how we're using all the data that we've been talking about today in a way that helps our clients to make the best decision for themselves, for their families, for their financial health. Harvard did a study about a year and a half ago now, where they actually looked at homeowners and renters at age 65. And those who rented were 48 times less wealthy than those that owned, both because of the equity gain in the home, as well as just the mentality that you become a saver when you do own a home. You start creating the nest egg. So somebody that owned a home was worth on average $319,000 versus somebody who was renting was only worth $6,700. I mean, that's game changer right there. That's exactly why I get up every morning and get excited about doing what I do. The more people that I can get into homes in a really safe, healthy way, the more opportunity we have for building wealth really across the city and across the United States. So Andrew, any additional questions?
We do not have any additional questions. You killed it so much that everyone is satisfied.
Awesome.
But we'll give everyone a last second chance here. Does anyone want to throw in any last second questions?
So, and if you want to reach Andrew or I, please feel free. Both of us do this because we love it. We're both active members on the committee. If you have any questions about the report, and I know Sarah will be sending out the slide deck. So you guys, if you do have any additional questions, just reach out to either one of us.
Perfect.